Hey everyone, welcome to the KE Report and a daily editorial on Friday, June 20th, chatting with Marc Chandler. Marc is the managing partner at Bannockburn Global Forex, also editor of the Mark II Market website. That's where Marc keeps all of us up to date on a daily basis in terms of any news, any data, and any key market moves, especially in the currency markets. Recommend checking out that Mark II Market website, which I'll put a link in the show notes. Marc, we're going to talk Fed meeting recap. We're also going to look at some of the recent data out of the US that continues to trend on the weaker side, as well as a quick currency update. The US dollar rebound that made it just above 99 and seems to be potentially rolling back over. Starting with the Fed meeting, it was a non event in the way that the Fed didn't do anything in terms of cutting rates, but under the surface, I think we did see a couple significant, potentially significant adjustments. They revised their GDP expectations down, their unemployment rate expectations rose, their inflation expectations were slightly higher, and that all tied into the dot plot where 7 members said no cuts this year, 2 said 1 cut this year, 7 said 2 cuts this year, and 1 was an outlier with 3 cuts this year. Seems like the Fed is very divided, and that's what they keep telling us in these meetings and in their statement. So, Marc, what did you take away from that Fed meeting this week?
Yeah, Corey, I think you're right that the real takeaway, I think, is not so much the shifts that took place, but just a wide dispersion of views from no cuts to 3 cuts this year. And that's the range of expectations from Fed officials themselves. And so I think that what it speaks to, and Powell addressed it a little bit, he said that uncertainty has declined since April, but it still remains elevated. And I think that uncertainty, I think that there's 2 words that sort of capture what's going on in people's minds, sort of the psychology. One is this uncertainty, picked up in the Beige Book, picked up in, you listen to these companies' earnings reports and the calls, and uncertainty keeps being mentioned. But the other word, I think you hinted at this with the Fed's upward revision to inflation, downward revision to growth. The other word that I see people using a lot is stagflation. I still don't fully buy the stagflation scenario because the stagflation of it really is we had a very low version of it, if you will. We're still talking about a 2% handle on CPI, on inflation, and we're still talking about the economy that's been growing above trend. So I think stagflation is probably an exaggeration, but I think that sort of captures the psychology. My sense on the Fed is that the views are very dispersed right now, and that just today we had Governor Waller, who some people expect to be on the short list of candidates to succeed Chairman Powell. That Waller, who's sort of moving more towards a dovish position lately, perhaps positioning himself for that nomination, said that he could imagine a rate cut in July. The markets do not believe it. However, the markets are almost pricing in a 75% chance of a cut in September. And this is partly predicated, I think, on that the tariffs don't have as big of a shock on inflation as some people are concerned about. And if it does, it's seen to be a one-off raise in prices rather than a trend in inflation. And I think that the growth prospects is really where it's going to come down to. Now, the Fed revised down its growth to 1.4% this year. And as we were talking about it off mic, a lot of the data surprise models have cratered really in the US. And you think about what's happened the past week, weaker than expected retail sales fell for the 2nd month in a row. We had another decline in industrial output, which is the 2nd time in 3 months. And then those housing data was just horrendous. And there we're looking at the new housing starts. And the market expected about a 1% decline. They fell by almost 10%. Building permits also, which go into leading economic indicators, were also weaker. And so it does look like, and Powell identified this as well, a lot of distortions by trade and the tariffs. And what dragged us down in Q1 is going to help us in Q2. But Powell admitted that it's very hard to get a clean gauge on the economy, which puts us relying more on these high frequency data, but not the survey data. the Fed has made a big point, I think, that the survey data they recognize as weak, but so far they say it hasn't really percolated into the hard data. And that's why that data surprise models are so important. The data surprise models tell us that the real sector data is coming in weaker than expected.
Mark, I think that's a great point you just made because the survey data now, people, the term uncertainty, we've been talking about uncertainty all year long so far. And so there's a lot of survey data where people have expectations that is not really in alignment with the hard data. So I could understand the focus on the hard data. When we dig into the hard data, you covered a lot of it there, but when you look at everything from manufacturing, real estate, retail sales, you brought up a lot of that consumer confidence. The surveys are a lot different than maybe what we're seeing in the quarterly reports and what we're looking at earning statements and forward guidance from the companies. So you're still looking at potentially a weakening economy this year, and it seems like the Fed's in alignment if they're lowering the GDP. What does that mean as far as the urgency factor, though? Like to Waller's comment, if you're going to cut in July, where is the urgency? Because things aren't really falling out of bed. So taking the other side of it, while things have weakened a little bit, they're not in a dire straight situation. So what would be the impetus for the Fed to cut rates right now? Would it be more to get in alignment with the bond market and bring down rates in that sense? Or is it more that they're looking ahead and reading the tea leaves and think that it's going to continue weakening for the balance of the year?
Yeah, I'm sure that Waller is going to be able to convince a sufficient number of colleagues that they want to cut in July. In fact, other Fed officials have spoken, and they've played down the sense of urgency that you note. So I think right now Waller would really be an outlier. When it raises to the level of dissent is a different story. But the reason why many people, including myself, think that September is a more likely time frame is that we do see the economy weakening. And remember what happens. I mean, we all look at these, when we think about the Iranian-Israeli war right now, gold fell this week. The dollar firmed a little bit. We can talk about that, but it's not so impressive. The only market that seems to have really responded is the oil market. And I know when we look at, excuse me, look at oil prices, people are concerned higher oil prices. It might translate to higher gasoline prices, higher inflation expectations. But in truth, higher oil prices cut both ways. The more it takes me to heat my house, air condition my house, or fill my car with gasoline, the less money I have to spend on other things. And that's what the Fed really recognizes that in the past, the sustained gains in oil prices have marked an end of the business cycle, not an inflationary spiral because it weakens demand more than boosting the general price level. So I'm watching oil prices carefully. And so the reason why people like me will think that the Fed could cut rates in September is we see the economy slowing, especially now, we didn't talk about that before, but in the labor market, it's also becoming more evident, not so much in non-farm payrolls, but in the weekly jobless claims. I think we're almost at 2-year highs on the 4-week moving average, and continuing claims are also elevated at, I think, the highest since 21 or so. And so we are seeing some signs of this weakness. Powell identified that in his comments as well, and the Fed did revise up its unemployment level projections for this year by about 0.1%. So the reason that Fed is going to end up cutting interest rates, we think, is not so much because of inflation is going to be back at the target, but rather the real sector economy is going to be rolling over, slowing, albeit gradually. And the Fed's forecast for 1.4% will be the first year that we have sub-trend growth, which they say is about 1.7% since the pandemic struck.
Yeah, it really seems like all this data that we're getting is weakening. Yes, it's not crashing, and I guess you take a step back and it still looks decent, but no, the trend is weaker in the US, and maybe that's why the dollar has been so weak this year because Mark, we talk about the dollar all the time, and quite frankly, the dollar broke to just below 98, I believe it was last week, rebounded throughout this week, but hardly got above 99 on the dollar index. And it's a pretty defined downtrend that the dollar is in this whole year. We're almost halfway through this year. What are you seeing in the currency markets then? It seems like, again, the dollar's weak. What else is going on?
Yeah, so I think the dollar's not. You're right. Now, when you look at the dollar index, you have to remember what it's made of, and the chief components are the euro and currencies that trade like the euro. Two of the U.S.'s four biggest trading partners, Mexico and Canada, excuse me, Mexico and China, are not even included in it. So it's primarily a Europe, like a euro basket with a little bit of Canada thrown in there and a little bit of yen. What I'm watching is this downtrend line that goes back till May 12th, and it gets the May 12th high, picks up the late May high. We've sort of been flirting with it yesterday when the U.S. markets were closed, and today, and it comes in around, call it on Monday about, I don't know, for the sake of an argument, depending on how thick your pencil is, call it about 98.75 or so. And I think that we're just below there now. And my sense is we need to take that out to be anything important. And even then, this past week's high was closer to a 99.15 or so. And we really have to, right now, I think given the sentiment, we have to get above those kind of levels in order to force some of the late shorts out. And that was one of the takeaways, I think, this week. One of the charts that made it into the social media, Bank of America, and maybe a couple of other banks showing that their view of their clients' positioning or surveys show that the short dollar position is crowded. You get paid to be long the dollar against most currencies right now, most of the major currencies, just because where the U.S. interest rates are. But it hasn't been sufficient to offset people's concern that the U.S. dollar is on a longer term downtrend. People are still the structural books. You think about what people were, and including Americans, overweight U.S. assets compared to their benchmarks, and it takes a while for these positions to adjust. And I think we're still in the middle of that.
Well, Mark, just as we talk here and we go through these different data points, you mentioned in the onset you didn't really feel like it's stagflationary, but if oil prices are going higher and the labor markets are starting to weaken and unemployment expectations are going up, inflation's not run away, but it's higher than the growth rate. It's, if you have a 2.4, 2.5% inflation rate and GDP is at 1.4, in real terms, you're got negative growth because of the inflation eating away at it. And it seems like we're going to have a stagnant economy. Isn't that stagflation?
I don't know. I think that stagflation, we don't have a lot of experience with stagflation. And people harken back to the 70s. You're talking about double digit interest rates, double digit inflation, talking about an economy that is very weak. The economy is not so weak right now. I mean, and this was partly something that we can do as investors and as market observers and commentators. Is Powell identified the key metric that helps clean up some of the data and in terms of GDP, and he called it final sales to private domestic participants. And what this does is it strips out government spending, it strips out trade, and it strips out inventories. And for the fifth quarter in a row in Q1, it was 5% or above. 5 quarters in a row. This is nominal growth. What we saw with the Q1 GDP, these are real terms, it was a contraction. But look at what the Atlanta Fed says. We're late enough into the quarter where their forecast or their tracker tends to be fairly accurate. As of the middle of the week, their model is tracking 3.4% growth annualized pace in Q2. That still is above the inflation rate. To your point, though, Shad, is that the Fed's forecast does have inflation for this year to be above the growth rate. They have the growth rate at 1.4%. They've got inflation still above 2%. But I still don't think that the Fed would acknowledge that as stagflation. I think that, again, what's going to happen is the higher price of oil, and oil is sort of this miracle product in the sense that it's important in the price of food, the fertilizer, the shipping of the goods. It's very, so oil is important not only in food. Think about the petrochemicals in it's plastic. It's the synthetic fabrics and fibers and all these other things. So oil is this key product, of course, that despite our green focus often these days, oil is still a key element to a lot of things that we consume. Higher prices is going to mean weaker demand. And so I think we're going to see this in other countries as well, where central banks have been cutting interest rates, leaving aside the U.S. And this past week, we were surprised by Norway cutting interest rates. I think nobody in Bloomberg's survey expected that. Sweden cut rates as expected. Switzerland cut rates as expected. But now I think we're going to go through a period in which the central banks are going to be pausing. We might not get further rate cuts until Q4 for most of the major central banks. And that would include, of course, the Federal Reserve.
So, Mark, this process, it all seems to be happening fairly slowly, right? Inflation is just hanging around where it's at, maybe trending a little lower, maybe trending a little higher. The data out of the US has been just generally getting weaker, but it's happening at a slow pace. Do you see anything on the horizon that speeds any of this up? Is there a shock coming to the system? Is there something that corrects the system and all of a sudden people or the economy is much more stable or on a better growth trend rather than slowly declining? What do you see coming that could change this, or simply is this just the environment we're in, that this slow and gradual shift to weaker data and who knows, maybe higher inflation?
Yeah, I think about that. Like, what direction are the shocks going to come from? And it seems to me right now there's two big means, if you will. One is the U.S. tariffs, and it's still a lot of uncertainty around them. But remember, the July 9th date is approaching, and that is when the reciprocal tariff postponement comes to an end. We also know that in the coming weeks, the investigations into pharmaceuticals, semiconductor chips, and several other industries will be coming to a head. That means that there could be more tariffs announced, sectoral tariffs. So the tariffs we know it's on the horizon, and the shock probably is a negative shock. And by negative shock, I mean higher tariffs, and the dollar looks like it tends to weaken as the tariff war escalates. The other thing, and the war proper, I sort of think that what's happening in the Middle East is a new phase of an existing war. The existing war was between Israel and Iran's proxies, Hezbollah and Hamas. And when the Iranians were cited by the UN not in compliance with the uranium enrichment agreement, Israel took advantage of that and struck the homeland, struck Iran itself. The war, it seems to me, has been so far fairly contained. The U.S. has been helping shoot down missiles aimed at Israel, and there have been reports about China sending cargo airplanes full of cargo with no details on what's in it. President Trump went back to his sort of standard statement. He's going to make a decision in 2 weeks. Somehow 2 weeks keeps coming up. It's not clear whether the U.S. is going to get involved. The latest report I read in The Guardian, a British newspaper, suggested that there's people in the U.S. defense establishment who are concerned that the key uranium enrichment site in Iran is over 300 feet underground. These bunker buster, mother of all bombs that have made it into the social media and capturing a lot of people's imaginations, the evidence suggests they only do enough damage down to about 200 feet. And so it's not clear what Trump is going to do. My best guess is that the U.S. does not do anything, that it accepts that what Israel is able to do, whether it's another week or so left in its campaign, that it's enough to set the Iranians back 5 or 10 years or something like that, and that leaves open then room for negotiations. Whether there's regime change or not is beyond my ken. My sense, though, is the U.S. does not get involved. Remember, when Trump gets elected, he partly campaigns in criticism of the neoliberals and these infinite number of forever wars in the Middle East.
All right, Mark, we'll wrap it up here. Kind of a busy week on the data front, and then also that ongoing Israel-Iran war, which, boy, oh boy, has really had a shock to the oil system after oil had broke down. Now it's right back in that trading range, and who knows where it's going, who knows how much longer that escalation of war is going to last. But overall, look, weaker, let's just call it, data out of the U.S. and the Fed even acknowledging that with a lot of their revisions in the last meeting. Again, Marc Chandler is a managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Click that link in the show notes to read over Mark's daily notes. Mark, thank you very much for your time. I hope you have a great weekend.
Good luck to everybody.